In March 2023, an event occurred that most people didn't even notice. Saudi Arabia and China signed an oil deal settled in Yuan. Sounds boring, right? Just some paperwork, some contracts. But you know what happened next? American financial analysts started frantically recalculating how many countries might follow this example. Because this boring piece of paper threatens the system that has kept the dollar the planet's primary currency for 70 years. Right now, every drop of oil bought by any country in the world is paid for in dollars. It doesn't matter if Saudi Arabia sells oil to Japan or Iraq supplies raw materials to India. Everything goes through the dollar. This isn't just a tradition. It's a system that forces all countries to hold huge reserves of the American currency. And it is this system that allows the U.S. to print money without fearing inflation, to impose sanctions with the stroke of a pen, and to live trillions in debt. So now the question: what happens if two of the largest oil powers decide to break this system? Not tomorrow, not in 10 years, but right now create an exchange where oil is traded for yuan, for rubles, for anything but dollars? Do you think this is just economic news for financial journals? Then explain why the price of your gasoline, your mortgage, your food at the supermarket directly depends on which currency the Arabs use to sell oil to the Chinese. Today, we will break down the scenario that has all the world's economists on edge, the scenario where the biggest buyer of oil and its biggest seller in the Middle East decide to do without the dollar. And believe me, the consequences of this will affect every single one of you, regardless of which country you live in or what you do. Let's start with the most important thing. Why is oil traded in dollars in the first place? In 1973, the U.S. struck a deal with Saudi Arabia. The Americans promised military protection and arms sales. In return, the Saudis agreed to sell all their oil only for dollars and to invest the proceeds in American bonds. The rest of the OPEC countries quickly joined this system. Thus, the petrodollar was born. From that moment on, any country that wants to buy oil must first buy dollars. Japan wants oil? Buy dollars. Germany wants oil? Buy dollars. Even if a deal goes between Venezuela and India, they still use dollars as an intermediary. This created an artificial demand for the American currency, which exists regardless of the state of the American economy. Here's a simple example of how this works in reality. Turkey wants to buy oil from Saudi Arabia. Turkey has its own lira. But the Saudis don't accept lira. They need dollars. Turkey goes to the foreign exchange market, sells lira, buys dollars. Then it gives those dollars to the Saudis for oil. The Saudis receive the dollars and use them to buy U.S. government bonds. The circle is complete. The U.S. gets cheap credit, the dollar remains in demand, and America can spend more than it earns. This system brought incredible advantages to the U.S. They can print money for their needs, and this emission is diluted throughout the world because everyone needs dollars to buy energy resources. Inflation in the U.S. remains under control because excess dollars settle in the reserves of central banks all over the world. Americans have lived beyond their means for decades with a national debt of $34 trillion, and it's fine. The system works. But in recent years, something began to change. China became the world's largest importer of oil. It buys over 10 million barrels a day, more than the U.S. And every time, China has to pay in dollars. Now think from Beijing's perspective. Why should we hold $1 trillion in reserves, buy American bonds at a meager interest rate, and depend on the currency of a country that sees us as its main competitor? Why should we strengthen the dollar when we want to strengthen the yuan? Saudi Arabia, in turn, has also started asking questions. Relations with the U.S. are not what they used to be. The Americans are developing their shale oil, becoming less dependent on imports. They criticize the Saudis over human rights, and most importantly, China has become the main buyer of Saudi oil. The logic is simple. If your main client wants to pay in yuan, maybe you should accommodate them. And this is where we come to the key moment. Imagine that China and Saudi Arabia officially announce the creation of an oil exchange in Shanghai or Dubai, where trading is done in yuan, Saudi riyals, and dollars are not needed at all. A trading platform where any country can buy oil with its own currency or with yuan, bypassing the dollar. What happens next? The first thing that will happen is a domino effect in other countries. If China and Saudi Arabia show it's possible, other countries will start wondering, why do we need to hold so many dollars? Russia, which has been reducing the dollar's share in its reserves for several years, will instantly join the new exchange. Iran, which is under sanctions and can't trade normally in dollars, will gladly switch. Venezuela will follow. But that's just the beginning. Brazil, which trades more with China than with the U.S., will think about it. India, the second largest oil importer, will start negotiations. African countries that sell resources to China will see an opportunity for diversification. Even European countries, which are formally America's allies, will quietly participate in the new system because economic benefit will outweigh political loyalty. Let's look at some specific numbers. Right now, about 80% of international oil settlements are in dollars. If the new exchange attracts just 30% of this market, the demand for dollars will fall by trillions. Trillions of dollars that are currently frozen in reserves and bonds will become unnecessary. Countries will start selling them. Here's the simple mechanism. The central bank of any country holds dollar reserves not for fun. It needs a safety cushion to buy oil and other goods. If oil can be bought for Yuan, why hold so many dollars? Exactly, no reason. Central banks will gradually convert dollars into yuan, euros, gold. It won't be an instantaneous collapse, but it will be a steady trend. What does this mean for the average American? The dollar will start to depreciate, first slowly, then faster. Imported goods will become more expensive. And in America, practically everything is imported, from electronics to clothing, from cars to food. Inflation, which the U.S. authorities kept under control due to global demand for dollars, will break free. The Federal Reserve will face a choice, either raise interest rates to the sky, killing the economy, or accept rising prices. Now imagine you're an average American with a mortgage, a car loan, and a student loan. Inflation is rising, your salary isn't keeping up with prices, and interest rates are soaring. Your house is depreciating in real terms, but you have to pay more for it. This isn't theory. This is what the collapse of the privilege to print the world's reserve currency looks like. But the consequences won't be limited to the U.S. The entire global financial system is built on the dollar. International loans are issued in dollars. Corporate bonds are denominated in dollars. Emerging economies have borrowed trillions in dollars. If the dollar starts to depreciate, it will become easier for these countries to pay off their debts in real terms. But if the American economy simultaneously enters a crisis, the dollar might actually strengthen due to a flight to safety. Then, developing countries would find themselves in a debt trap. The conclusion from the first part is simple. The petrodollar system isn't just an economic scheme, it's the foundation of American power. And if China and Saudi Arabia create an alternative, they aren't just opening a new exchange, they are launching a process that will change the global balance of power. A process that will be almost impossible to stop. Now let's dig deeper and see what happens to world trade. Because it's not just about oil. Oil is just the first stone in an avalanche. If the biggest players show that it's possible to do without the dollar for the planet's most important commodity, why not do the same with other goods? China has been promoting the idea of trading in yuan for several years. They created the Cross-Border Interbank Payment System, CIPSE, an alternative to the American SWIFT. They have signed currency swap agreements with dozens of countries. They opened offshore yuan centers in London, Singapore, Frankfurt. All of this was preparation. An oil exchange without dollars will be the trigger. Here's how it will work in practice. China buys oil from Saudi Arabia for yuan. Saudi Arabia receives yuan. What to do with them? Before, the problem was that you couldn't buy much on the global market with yuan. But now China offers a solution. The Saudis can use these yuan to buy Chinese goods, invest in Chinese projects, participate in the Belt and Road Initiative, or convert yuan into gold on the Shanghai Gold Exchange. Pay attention to that last point, gold. China has turned the yuan into a currency backed not by promises, but by a real asset. You sold oil for yuan, don't want to hold them? Please, buy gold. This is a genius move because it solves the main problem of any national currency aspiring to a global role, the problem of trust. Now, let's take a concrete example. Brazil trades with China for hundreds of billions of dollars a year. Currently, this trade goes through dollars as an intermediate currency. Brazil sells soybeans and iron ore, receives dollars, converts them into reals. China sells machinery and electronics, receives dollars, converts them into yuan. On each conversion, percentages are lost in commissions and exchange rate differences. But if an oil exchange in yuan exists, it means the yuan has become a full-fledged currency for international trade. Why would Brazil and China need to use dollars as an intermediary? They can trade directly in yuan or reals. Savings on commissions, reduced currency risks, independence from the American financial system. The benefit is obvious. Multiply this example by dozens of countries. Russia and India trading in rupees and rubles. Turkey and China in lira and yuan. Iran and Pakistan in rials and rupees. The dollar is gradually being squeezed out of international trade. Not completely, of course, but its share falls from 90% to 70%, then to 50%. Every percentage point is billions of dollars in lost demand. And what happens to American companies? They have enjoyed the advantage of the dollar system for decades. An American corporation can take out a loan in dollars at a low interest rate because the dollar is a world currency with huge demand. A European or Asian company pays more for loans in its own currency because the risks are higher. This gave American corporations a competitive advantage. If the dollar loses its status as the main reserve currency, this advantage disappears. Loans for American companies become more expensive, their competitiveness falls, investments go to other countries where production is cheaper and financing is more accessible. Jobs in the U.S. are cut. Economic growth slows down. But there is another side to the coin. For most countries in the world, reducing the dollar's role is a liberation. They are no longer hostages to American monetary policy. When the Fed raises rates, capital flees from emerging markets back to the U.S., causing crises. When the Fed prints money, developing countries get imported inflation through more expensive imports. Take Argentina as an example. The country is chronically dependent on dollar loans. Every time the dollar strengthens, it becomes harder for Argentina to service its debt. Another crisis begins. If Argentina could borrow in yuan or trade in pesos without being tied to the dollar, many problems could be avoided. The same goes for Turkey, South Africa, Indonesia, and many other countries. Therefore, creating an oil exchange without dollars isn't just a blow to the U.S. It's a chance for half the planet to escape from under American financial control. And many countries will take this chance, even if they publicly speak of loyalty to Washington, because economic interests are stronger than political declarations. Now, let's talk about how this affects geopolitics. Financial power is the basis of political power. As long as the U.S. controls the global financial system, it controls most of the planet. Not with tanks and missiles, but with sanctions and disconnection from dollar settlements. It's a weapon that doesn't kill people, but destroys economies no worse than war. Remember what happened to Iran. The Americans disconnected Iranian banks from SWIFT, forbade them to trade in dollars. Iran's economy collapsed. The national currency depreciated several times over. Protests began. The same was done to Russia after the start of its military operation in Ukraine. They froze $300 billion in reserves, disconnected it from SWIFT, and banned dollar settlements. It was a demonstration of the power of the American financial system. But now imagine a world where an alternative financial system based on the yuan exists. A country under American sanctions is no longer doomed to isolation. It simply switches to the Chinese payment system, trades in yuan, buys oil on the new exchange. Sanctions lose their destructive power. America loses its main weapon of influence. Take a hypothetical example. The U.S. imposes sanctions on Pakistan for some actions Washington doesn't like. Previously, this would have meant catastrophe for the Pakistani economy. But now Pakistan turns to China. China provides a credit line in yuan, helps with trade through the new exchange, connects it to the CIPS system. Pakistan survives. The sanctions don't work. The U.S. is left with nothing. This completely changes the balance of power. Countries stop fearing American displeasure because there is an alternative. They can pursue an independent foreign policy without looking over their shoulder at Washington. China, having created this alternative system, gains enormous influence, not through military bases but through economic dependence. And here an interesting question arises. Which is better, to depend on the American financial system or the Chinese one? Because we shouldn't have any illusions. China is creating an alternative not out of noble intentions. It wants to replace American hegemony with its own. Yuan instead of the dollar, CIPS instead of SWIFT. the Shanghai Exchange instead of the New York one, simply changing the master of the system. For most developing countries, this might even be beneficial. China offers investments without political conditions. It doesn't demand democracy, human rights, freedom of the press. It needs resources, markets, and loyalty in international organizations. For many authoritarian regimes, this is a more convenient partner than the U.S., with its endless lectures about values. But for Europe, this is a catastrophe. The European Union is stuck between a rock and a hard place. On one side, the U.S. is its ally and security guarantor. On the other side, China is a huge trading partner on which the European economy depends. If the world divides into dollar and yuan zones, Europe will have to choose, and any choice will be painful. If Europe remains in the dollar zone, it will lose access to cheap energy resources from the new exchange. The energy crisis, which already hit after the rejection of Russian gas, will worsen. Industry will become uncompetitive. If Europe joins the yuan zone, it will destroy the transatlantic alliance. America will not forgive this. Most likely, Europe will try to sit on two chairs, officially support the dollar, but secretly participate in new settlement schemes. European companies will trade with China in yuan through intermediaries, hiding behind formal excuses. This will create tension between the EU and the US, which could lead to serious political consequences. The conclusion from the second part is this. Creating an oil exchange without dollars is not just an economic project. It's a geopolitical revolution. It redraws the map of influence, deprives the U.S. of its main tool of coercion, and creates an alternative center of power. The world is moving from unipolarity to multipolarity, not in words, but in deeds, through the financial system. Now let's talk about the most painful part, about how all this will affect ordinary people. Not states, not corporations, but you personally. Because when global financial systems collapse, ordinary citizens pay first. Let's start with the most obvious, prices. If the dollar loses some of its value, imported goods in the U.S. will become more expensive. Smartphones, computers, clothes, furniture, toys. Most of this is produced in Asia. If before a weak dollar was compensated by low production prices, now that won't be the case. Chinese manufacturers will start raising prices in dollars, compensating for the loss of currency value. Food will also become more expensive. The U.S. imports a huge amount of food, fruit from Latin America, fish from Asia, coffee from Africa. The transportation of all this is tied to the price of oil. If oil starts to become more expensive in dollar terms due to demand shifting to other exchanges, logistics will become more expensive. The final price for the consumer will rise. But these are only the direct effects. There are indirect ones that hurt more. Interest rates. Right now, the U.S. can borrow money at low interest because the whole world buys American government bonds. They are a reliable asset denominated in the world's reserve currency. But if the dollar loses that status, demand for bonds falls. To attract buyers, the U.S. government is forced to increase yield, and that means raising interest rates. High interest rates are a nightmare for everyone living in debt. And in America, almost everyone lives in debt. Mortgages, car loans, credit cards, student loans. The average American owes tens of thousands of dollars. When rates rise, servicing this debt becomes more expensive. People have less money for living. Consumption falls. The economy slides into recession. Take a concrete example. A family took out a mortgage on a house at 4% per annum. They pay $2,000 a month. A few years later, rates have risen to 8% due to falling demand for government bonds. It's time to refinance. Now the family has to pay $3,000 a month. Where to get an extra $1,000? Either cut spending on everything else or sell the house at a loss. Millions of families would find themselves in this situation. What about jobs? When the economy enters a recession, companies start cutting costs. The first thing to go is salaries and jobs. Unemployment rises. People who lose their jobs can't pay their loans. Banks get a wave of defaults. Some banks, especially small regional ones, can't withstand it and go bankrupt. Depositors lose money despite deposit insurance, which doesn't cover all losses in a systemic crisis. This isn't fantasy. This is exactly how the 2008 financial crisis unfolded. Only then the trigger was the mortgage bubble. In the case of the petrodollar's collapse, the trigger would be the loss of the dollar's reserve status. The mechanism of destruction would be similar, but the scale could be larger. Now let's look at other countries. For Europe and Japan, which also have high-status currencies, the consequences will be mixed. On one hand, the euro and yen could partially benefit from the redistribution of reserves. Central banks reducing dollar reserves will buy euros and yen. This will strengthen these currencies. But on the other hand, an overly strong currency is also a problem. European goods will become more expensive for the rest of the world. Exports will fall. German industry, French agriculture, Italian fashion, all will suffer. Jobs in export sectors will be cut. Unemployment in the EU, already high in the south, will rise even further. For developing countries, the picture is more complex. Those who manage to quickly integrate into the new Yuan system will benefit. They will get access to cheap financing from China, be able to trade without dollar intermediaries, and reduce currency risks. But those stuck in the middle will suffer the most. Their dollar debts will become harder to service, and new sources of financing won't have appeared yet. Take African countries. Many of them owe huge sums in dollars to the World Bank, IMF, and private creditors. If the dollar strengthens in the short term due to a flight to quality, it will become unbearably hard for these countries to pay their debts. Defaults will begin, economies will collapse, social unrest, coups, humanitarian crises, and all because of a restructuring of the global financial architecture in which these countries didn't even participate. Now let's talk about the less obvious things. For example, pensions. Pension funds all over the world are invested in American assets. Shares of American companies, U.S. government bonds, corporate bonds. If the American economy enters a prolonged crisis due to the loss of the dollar's reserve status, the value of these assets falls. People's pension savings evaporate before their eyes. Imagine a teacher in California who has been paying into a pension fund for 30 years. He planned to retire in 2 years and live on $4,000 a month, but his fund is invested in U.S. government bonds and tech stocks. The bonds lost value due to rising rates. The stocks fell due to the recession. Now, his pension isn't $4,000 but $2,500. You can't live on that. He will have to keep working or drastically lower his standard of living. Millions of people will find themselves in the same situation. Or take students. In the U.S., student debt has exceeded $1.5 trillion. Young people graduate from university with debts of $50,000, $100,000, $200,000. They plan to pay them off gradually, working in a stable economy. But if a recession begins, finding a good job becomes much harder. Salaries fall, and the debt remains. A whole generation finds itself in a debt pit with no way out. Social tension grows. People see their standard of living falling, and politicians can't do anything. Protests begin. The popularity of radical movements on the left and right grows. Society becomes polarized. The political system cracks at the seams. History shows that economic crises often lead to political upheavals. The Great Depression led to Hitler's rise in Germany. The crisis of the 1970s spawned a wave of revolutions in the Third World. But let's also look at positive scenarios, because not everything will be bad. For some countries and people, the new financial system will open up opportunities. China obviously will be the main beneficiary. Chinese companies will get access to cheap financing in yuan. The yuan will become a prestigious currency that everyone wants to hold in reserves. Chinese banks will move to the forefront of global finance. Countries that quickly adapt to the new system will also win. For example, India. If it manages to negotiate with both the U.S. and China, playing on the contradictions between the two giants, it will get the best terms from both. Access to cheap oil from the new exchange and preserve ties with the American market. Such multi-vector politics could bring huge dividends. For ordinary people in these countries, this means economic growth, new jobs, rising wages, improved infrastructure thanks to Chinese investment. The middle class in Asia, Africa, and Latin America could grow sharply. Hundreds of millions of people could escape poverty. This is a grand positive effect that cannot be ignored. Even in the U.S., all is not lost. The crisis will force the country to reform its economy, bring back production that flowed to Asia, invest in education, infrastructure, new technologies, stop living beyond its means and start earning its keep through labor, not by printing the reserve currency. This will be a painful process, but in the long run, it could make the American economy healthier. Take the auto industry as an example. In recent decades, American automakers couldn't compete with Asian ones. Costs were too high, managers' salaries bloated, technologies outdated. They survived only thanks to market protection and cheap dollar credit. If these advantages disappear, the industry will either die or radically restructure. New, flexible, and efficient companies will appear. Engineering culture will be revived. In 20 years, American cars could become competitive again. The same goes for technology. Silicon Valley dominates not only thanks to talent, but also thanks to access to huge capital. Venture funds invest billions in startups because America has cheap money. If this advantage disappears, innovation centers could shift to Asia, but Americans won't lose their creativity. They will simply be forced to work more efficiently, to create breakthrough technologies with fewer resources. For the average person, all this means one thing: a period of turbulence, 10, maybe 20 years of economic instability. There will be ups and downs, crises and recoveries. The familiar world where the dollar rules supreme and the U.S. guarantees stability will end. A new world, multipolar and unpredictable, will begin. In this world, adaptation skills will become more important than a stable career. The ability to work with several currencies will be more important than keeping savings in one. Diversifying assets between countries and currencies will become not a luxury for the rich, but a necessity for the middle class. People who understand the new rules of the game earlier than others will be able not only to survive, but to get rich. The conclusion from the third part is simple. The creation of an oil exchange without dollars will affect everyone, from a retiree in Texas to a farmer in Kenya. No one will be left aside. It will be a painful transition, but it is inevitable. The old system has exhausted itself. The new one is being formed right now, and it's better to understand what's happening than to wake up one day in a world that has changed beyond recognition. So let's summarize everything we've discussed. The creation of an oil exchange without dollars is not just a hypothetical scenario. It is a real threat to American financial hegemony that is already beginning to materialize. Saudi deals with China in Yuan, the growing share of alternative currencies in international settlements, the creation of parallel payment systems. All these are the building blocks of the future structure. The question is not if this will happen. The question is how quickly and on what scale. If the process goes gradually, over 20 or 30 years, the global economy will have time to adapt. There will be time for a smooth transition, for building new mechanisms, for softening the blows. But if China and Saudi Arabia decide to force the issue, announcing a full-fledged exchange with broad participation in the coming years, the consequences will be dramatic. The U.S. will not give up without a fight. They will try to preserve the petrodollar system by all available means. This could include diplomatic pressure on Saudi Arabia, reminders of the military security guarantees Washington provides to Riyadh. It could be economic sanctions against countries using the new exchange. It could even be forceful pressure, although a military conflict with China is too risky. But the truth is, the U.S. is limited in its options. It cannot force the whole world to hold dollars if it's no longer beneficial for the world. It cannot threaten China, whose economy is comparable in size to America's. It cannot forever rely on the inertia of a system that worked for 70 years. Sooner or later, the system changes, and all signs point to that time coming. For ordinary people, the main lesson is this: live within your means. Don't take on debt you can't service in a worst-case scenario. Diversify your savings. Don't keep all your eggs in one basket, be it dollars, euros, yuan, or anything else. Invest in skills that will be in demand in any economic situation. Learn, adapt, be flexible. For governments, the lesson is different. Don't cling to the old just because it's familiar. If your economy depends on the dollar, start diversification now. Build ties with new financial centers. Participate in creating alternative settlement systems. Don't wait until the crisis hits and you have no choice left. For business, the lesson is that geopolitics has again become a critical factor. For the last 30 years, globalization created the illusion that the world is one big borderless market. Companies built supply chains spread across the globe without thinking about the risks. Now those risks are materializing. The world is dividing into blocks again. Companies will have to choose which block they operate in or pay a huge price for balancing. And the most important conclusion is philosophical. We are living through a historical turning point. A system that seemed eternal is in its final years. A new world order is forming before our eyes. It's happening not through wars and revolutions, although they are possible too. It's happening through boring things like oil exchanges, currency swaps, international settlements. But beneath this boring surface, tectonic shifts are simmering. History did not end in 1991 when the USSR collapsed. It did not end in 2008 when Lehman Brothers fell. It continues. And the next chapter is being written right now. A chapter about how the dollar lost its crown, how America ceased to be the sole superpower, how the world became truly multipolar. You can ignore these processes. You can think they don't concern you. But when prices in stores rise by 30%, when your salary no longer covers expenses, when your pension turns out to be half of what you planned, you will remember that someone warned you. That someone explained how the petrodollar works and why its collapse will change everything. So here's what I suggest. Share this video with friends, family, colleagues. Let more people understand what's happening. Knowledge is not a guarantee of protection from crisis, but it's better than blindness. A person who understands the mechanisms can at least prepare. They can adjust their plans, revise their strategy, take measures. Subscribe to the channel if you want to continue understanding the processes that shape our future. We will follow the development of the situation with the petrodollar, analyze the steps of China and Saudi Arabia, and track the U.S. reaction. This is not a conspiracy theory, not panic-mongering, not alarmism. It is a sober analysis of reality. Like the video if it was useful. Write in the comments what you think about this scenario. Do you find it realistic? How are you preparing for possible changes? What other topics interest you? I read all comments and take your wishes into account when preparing new videos. And remember the main thing, the world changes. It has always changed and will always change. Those who understand the direction of change and adapt to them survive and prosper. Those who cling to the past and deny reality are left behind by history. The choice is yours. Thank you for watching until the end. See you in the next video.